This is Turkey, and over the past few years, inflation in the country has skyrocketed, reaching a whopping 80%. Over half of Turkey's population can't afford their daily bread and butter, all because of an economic crisis largely caused by this man. In the last 2 decades, Turkey has been the star of the show in terms of economic growth, boasting numbers that made the world sit up and take notice. Living standards were soaring, and it all seemed like a perfect backdrop for Erdogan's political campaign. However, around 2018, Erdogan decided to stray off the beaten path. Here's the thing. Erdogan, for some strange reason, thought high interest rates were the evil mastermind behind the country's inflation. He argued that they only serve to make the poor poorer, neglecting the fact that they also keep the economy in check. Following his own tune, he dismissed 3 central bankers and took the reins of the economy. Predictably, chopping down interest rates in the middle of an inflation crisis was like pouring gasoline on a fire. It only made things worse. This drastic slash in interest rates gave Turkey the dubious honor of having the cheapest borrowing costs in the OECD, fueling investment and consumption. But this cheap money only ended up adding fuel to the inflation inferno. For the middle class, the situation was heart-wrenching. They watched in disbelief as grocery and energy bills doubled in a matter of weeks. Imagine going to the store to buy a loaf of bread and coming back with half because the price doubled overnight. It's like living in a nightmare where UK or US inflation is on steroids, 10 times worse. Savings are evaporating faster than water in the desert, leaving trails of uncertainty and confusion. The government did try to throw a lifeline by increasing the minimum wage and pensions, but with inflation running rampant, these benefits were as fleeting as a Snapchat message. Erdogan claimed high interest rates were the villains of the story, hurting the poor the most. But the real monster is inflation. It's the one gobbling up the well-being of average workers like a pack of hungry wolves. The privileged few, big businesses, and the well-connected manage to create a safety bubble by holding foreign currency reserves or buying tangible assets, like land and property. But for the struggling workers, this safety net is as elusive as a unicorn. Basic necessities have become luxuries, and debt has become a constant companion. In this dire situation, many skilled workers are packing their bags and seeking greener pastures, leading to a brain drain. The hyperinflation also caused the Turkish lira to nosedive, pushing up the price of imports. For a country that heavily relies on energy imports, this has been a devastating blow, especially with rising oil prices. Turkey's predicament doesn't stop there. It also has a persistent current account deficit, meaning it imports more than it exports. This situation reflects both high consumer demand for imports and an underdeveloped export sector, exacerbated by high inflation. In just 3 years, Turkey's deficit has ballooned from $33.1 billion in 2016 to a whopping $51.6 billion in 2018. This escalation places Turkey among the nations with the highest current account deficits worldwide, an undesirable distinction for any economy. Erdogan had hoped that high interest cuts and devaluation would allow Turkey to replicate China's economic miracle of strong export growth. However, this strategy has not proven successful. Turkey's approach to managing these gigantic deficits has largely hinged on ensuring a steady flow of money into the country to sustain its extravagant private sector. That money was coming mostly from its banks and big corporations, and they've acquired most of it by borrowing like there's no tomorrow. The nation is also grappling with a growing external debt, which is becoming increasingly difficult to finance due to devaluation. To top it off, the devastating earthquake earlier this year could cost up to $80 billion, or 10% of GDP, to repair. Amidst this chaos, Turkey is walking on a tightrope, trying to maintain its position as the meeting point of the East and West. However, Erdogan's increasing authoritarianism, high inflation, and perceived closeness to Russia have made Western firms more hesitant to invest in Turkey. Despite its gloomy economic landscape, Turkey's economic growth surprisingly remains high. But this is like a sugar rush, exciting and energetic, but short-lived. It's reminiscent of the 1980s Lawson boom in the UK, where high confidence and rising asset prices led to a boom in consumption, a current account deficit, and higher inflation. But like all good things, this too shall pass, leaving behind a painful recession. This whole saga serves as a stark reminder of the perils of an autocratic leader running the economy based on personal whims, without heeding any independent advice. After all, you can't simply bend the laws of economics to your will. If you cut real interest rates to -20, there's going to be an inflationary impact, no matter how you look at it. The silver lining in this cloud is Turkey's entrepreneurial spirit, which remains undeterred despite the challenges. However, the current inflation crisis is a ticking time bomb, eroding living standards and damaging the long-term prospects of the economy. Only time will tell how Turkey navigates this storm. But for now, it's safe to say it's stuck between a rock and a hard place.